Welcome to my presentation. I'm Vinay Kumadsi, Assistant Professor, the subject Personal Investment Management, online class to second BCom students. Last class we are discussed the various information towards savings versus investments, need for investment. Under the need for investment, we discussed grow your money, saving for retirement, earn higher returns, reach financial goals, support others, reduce taxable income, like that we are discussed. So that information is too essential for the purpose of examination also. So investment is basically, it is a requirement for all the people, especially those who are working. So in this class we give the more importance to the various steps of investment. What are those steps it is required for investment? The first one is put and take account. This is the first saving you should establish when you begin making money. Definitely it is too important that all the various peoples, you need to have a bank account. The bank account may be in the form of saving account, may be in the form of current account, so whatever it is. So compulsory account is required. The second step is beginning to investment. So this is the second step. So if you are having those account, at least you need to have a sufficient balance, and also regularly save your money, at least 1500. So belongs to your savings. Okay, based on your salary, how much it is possible to save. So that much of money you should invest, or that means you should invest in the bank account. Okay, so as per the experts, 5% of the salary is definitely a good saving. The third step is systematic investing. So investment should not be non-recurring in nature, it should be recurring in nature. That means a systematic investment is too required. So this month you are investing 5000, in next month also you should invest 5000. Okay, so up to 12 months every month should be 5000 like that. So if your salary is too less, minimum 500 rupees should save a daily or a monthly, you need to save those money. So that's why it is one of the steps that systematic investing is always a good decision. The fourth step is strategic investing. So you should not blindly invest your money in only in bank account. Okay, you can have a lot of opportunity. So somewhere you can put your money in provident funds or in the pension schemes, those who are elders. So you should save your money in the pension scheme also. Some some people they may also go for investing money in shares. Okay, that is also one of the opportunity. So strategy is too important. So how much return you are getting for your money, what is the risk towards those investments, so everything is important. So strategy is always one of the steps in investment. Last one is speculative investing. Speculative investing, it relates to a stock market. Okay, where you can buy the shares, and when the price is increasing, the price of the shares is increasing, you sell those shares. That is speculative. Okay, so when the share price is less, you can buy those shares. Okay, so that is the strategy. That means that is the speculative activity that is happens in stock market. So these are the various steps towards the steps of investment. This is the one of the important point, that is principles of investment. So always I am saying this is the elective paper. in an examination 2 marks questions, 5 marks questions, and then 10 marks question also you can expect. So that's why uh, it's questions like 2 marks, questions like 4 or question marks 8 you may expect. Okay, there is no 20 marks question or 21 marks question in this chapter. So the questions may be the meaning and terms of saving, what do you mean by investment, and what are the difference between investment and saving, and what are the principles of investment. Write any 2 principles of investment and diversification of investment, like that. That question may be for 2 marks. Okay, that's why you should maintain the notes towards this topic. So under the principles of investment, there are numbers like liquidity, safety, profitability, diversification are the various principles of investment. So, firstly, what do you mean by investment? Principles of investment. So, as per the experts, they say investing a principle is the original sum committed to the purchase of asset, independent of any earnings or interest. In business, principles are those who own a majority of stake in a company and play a significant role in running it. So this is the topic which is relates to the investment. So it is an independent activity. Okay, so you can get the earnings independently, and interest also you can get the independently. In business also, so you can majority of the stake in company or play a significant role in running it. So as earlier I say that the principles of investments are liquidity. The first one is liquidity. So liquidity, which is relates to the tide over any financial crisis that we may come across in near future. But if we can cover all loopholes, then liquidity becomes less important. Suppose you start a SIP of 5,000 per month in an equity mutual fund. The purpose of the same should be continued less than 5 to 7 years, but if in case there is a medical emergency, then we can think of a redemption of those units of funds. Imagine we had a medical insurance in place, the SIP could continue without any financial disturbance. So liquidity nothing but it is in the form of money. Okay, so it is not important when you are investing those money in a SIP. SIP it is a one type of a investment. Okay, it is a short term investment up to 5 to 7 years. So you should not skip. That means you are paying a regular what you are saying that regular investment you are doing under SIP. Some emergency may happen. Okay, maybe the medical emergency, so you immediately require money. Okay, you don't go for withdraw that money in SIP. Okay, better to have an health insurance, so like that. So that's why I'm saying all the loopholes, then liquidity becomes less important. Okay, then liquidity does play a very important role, especially if you are nearing your financial goals. For example, if the investment which starts some 15 years ago for daughter's marriage, then definitely the investment must be withdrawn. When the marriage date draws a closure, liquidity will be the principal criteria for our investment. So not only at the time of daughter marriage, even though for education purpose, you can invest those money up to 15 years. Okay, so there is some type of investments are there like a provident fund or public provident fund, PPF, public provident fund. Okay, when you are investing those money in public provident fund, so minimum years are 15 years. Okay, after the 15 years with interest you can withdraw your money. Okay, even though the other type of investment like fixed investment, fixed deposit, where the fixed deposit you can take your decision. So minimum 5 years. There is no some investment may be for up to 2 years, 3 years, 5 years, even though for long term for 10 or 15 years, like that. So that type of opportunities are there. Anyway, for the liquidity purpose, it is a planning. It is one type of planning, investment planning, that the investor can take the decision when the money is required. So for your son or daughter's education, for your son or daughter's marriage, at the time the huge money is required. Okay, so that's why you make a planning earlier. So liquidity is a one of the principles of investment. Some peoples are there, they always looking at safety. Is it whatever the money I invest, shall I get the principal amount? So that is important, because some institutions are there, some corporations are there. So maybe that corporation may not be registered. Okay, at that time, maybe some fraud maybe happens. Okay, so this is happening everywhere. Somewhere the people, they are investing money in the form of chit funds. Majority, 20 to 30% of the people, they are doing this type of fraud activity. Okay, some people definitely they are doing good work, but as per the law, chit funds are not good. That means non-registered investment, non-registered chit funds are not safe. So safety or security of investment is a very big consideration for conservative investors. For an aggressive investor, it may not be a top priority, because the focus is more on higher returns. So I'm not telling that only chit funds. Even though there is some type of speculation activity, some people, they are investing money in shares. They don't want to invest that money for long term. So shortly, they want huge return. They're doing speculation. Okay, so on that type of speculation activity, there is a higher risk, and also the higher return, and also the zero return also. Okay, that is that type of risk you may have. So anyway, safety, it depends upon your investment, and decision is yours. Profitability, some people always they looking profitability and also the good return. Definitely it is a basic choice of any type of investor. Okay, and also it is a criteria for investment. If not for returns, the investor would have been better off with investment in bank deposits, public provident fund, government bond, etc. So surely, definitely, if you are investing in your money in nationalized bank, and always I say is that public provident fund, government bond, they are giving security. Okay, so definitely return may be minimum. So at least you can get minimum returns. For example, a PPF account would give a moderate of 7.9% returns with no liquidity, but an equity oriental mutual fund could give an average of 12 to 15% return over a period of 5 to 7 years. It is a temptation and the risk bearing ability of an investor. Okay, the next principle is a diversification. It is one of the most important principles of investment. It goes without saying that a well diversified investment can give both safety and better returns. It is connected with a very old adage, don't keep all eggs in one basket. A well diversified portfolio of investment can average out the risk and arising from one sector with returns from another sector. It is a better decision. It is one of the good principles of investment. Okay, you don't put your money in only in bank account or only in shares. Okay, you take some type of a mutual fund. So it is a minimum risk there. Okay, those people, they are the experts. They are working in those mutual fund institutions, and they take the decision. A portfolio decision is taken by those experts. So that's why, so financial resources, those who cannot track the stock market on daily basis, SIP of various mutual fund offers a great diversified platform for investment. So you can also consider the other, like tax simplification. So it is also an important aspect. Investment should give better returns at the same time be tax efficient. It is a very rare combination, but few investment products do exist in the market, but a lack in period. You have stay invested for a minimum number of years. Example, equity linked saving schemes is a tax efficient investment product with average return but has a lock in period of minimum 3 years. So point to be noted, investment should be more for the sake of wealth creation and not just with the objective of earning negligible returns and saving a tax. The other aspect is principle of investment is rate of interest. Rate of interest is a criteria that can be looked upon by an investor at the time of starting to invest. But in the long run, it does not matter. There cannot be guarantee of fixed rate. It is always a risk averse investment that specifies the rate of interest. In all other cases, the investment, the market performance of the investment product decides the rate of return. Next one, inflation. Every informed investor will and should consider the inflation is the greatest enemy of any investment. The return that are mentioned are usually before adjusting tax and inflation. A good investment will always beat the inflation hands down and provide handsome returns to the investor. Example, we invest in 5 years fixed deposit in a bank with 6.5% returns, and if the inflation rate prevailing in the market is 4%, then the net adjusted returns before tax would be paltry. That means 6.5% to 4% comes to 2.5%. Many investors are not aware of this at all. So the need of the hour is an investment which gives a better net adjusted returns, which is efficient both from the tax and inflation point of view. What are those fundamental investing principles? You can add the further fundamental principles towards this investment, that is, embrace an investing strategy, invest with a margin of safety, asset allocation, diversification is vital, invest for the long term, keep expenses low, use compounding to your advantage, employ risk management strategy. So these are the various type of the fundamental principle investing. So for the purpose of 8 marks, at least you should write the 8 points, and also you should give the explanation for this. Okay. Anyway, for watching, thank you.